Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. Last month, the economic concern was tariffs. This month, the focus has shifted to federal debt and deficit spending. Furious negotiations are currently underway in Washington for Congress to pass a new tax and spending bill. Back in 2017, the Tax Cut and Jobs Act passed. Tax rates for individuals and corporations were reduced. The act also increased the standard deduction while capping state and local taxes, known as SALT, and mortgage interest deductions. Without action from Congress, most of the provisions of the 2017 Act will expire at the end of this year. Details of a new tax and spending bill are being worked out, but we can expect most of the provisions of the Tax Cut and Jobs Act to be extended permanently. Also under discussion is an increased deduction allowance for state and local tax to $40,000 from $10,000 currently. And then there's a temporary elimination on taxes on tips, overtime pay, and Social Security benefits. Making car loan interest tax deductible is also on the table. All these changes reduce tax revenue, which means the government will have even less to spend. There are proposals to reduce expenses as well. Congress is looking to cut Medicaid benefits for anyone not working 80 hours a month, for example, and to cut food stamp payments. But the savings are far less than the loss of revenue. Therefore, the net effect is estimated to increase debt by more than $3 trillion over the next 10 years. Here's a chart of the U.S. public debt for the last 25 years. You can see the acceleration from COVID stimulus spending, and we've just moved higher from there. U.S. government debt currently stands at $36 trillion, which is about $20,000 per person. The total annual federal budget, by comparison, is $6.8 trillion. Interest payments on the debt will reach nearly $1 trillion this year. That's more spent on interest than our entire military defense budget. Everyone likes lower taxes, but when tax revenue falls and expenses remain, deficits go up. For politicians, it's easier to kick the can down the road, reduce taxes, keep spending, and let someone in the future deal with the consequences. This is not a uniquely American phenomenon, and some level of debt is fine and frequently necessary, as long as it's managed appropriately. Our debt is not yet a crisis, but we are already seeing a negative impact. The deeper in the hole we get, the more painful it is to course correct. More revenue needs to be raised through taxes, and more government services will have to be cut. Although $36 trillion in debt seems unfathomable, a good rule of thumb is to keep debt below 100% of gross domestic product. U.S. GDP is $30 trillion, so we have recently exceeded that threshold. For investors, the debt load generally does not have a direct impact on the stock market. Stock prices are driven by earnings. Unsustainable public debt does not impact corporate earnings directly, but there are indirect considerations, and they are starting to have an impact on stocks. The fiscal condition of the country directly affects credit markets, however. Bad fiscal policy results in higher interest rates and a weaker currency, both of which do affect stock prices. As debt loads increase, loans to the U.S. government in the form of treasury bonds start to look riskier. This reduces demand for the bonds and pushes interest rates higher, making the interest payments on the debt even greater. The 30-year U.S. Treasury bond exceeded 5% today for the first time in 18 years. This year, fiscal policy out of Washington has been a toxic combination of tariffs and deficit spending. Consumer sentiment is close to the lowest level ever recorded, and foreign money, which has been parked in U.S. Treasuries, is leaving. The U.S. dollar index is down more than 8% this year. Imported goods will be more expensive due to both tariffs and a weaker dollar, keeping inflation elevated. Reducing consumer demand, in turn, this affects corporate earnings, directly impacting stock prices. Again, the stock market is driven by earnings. Investors need to watch inflation, jobs, and economic growth. They matter the most. But it's time to worry about the federal budget deficit, our ballooning debt, and rapidly rising interest liabilities. Spend now, pay later is not sustainable forever. For the stock market, the more immediate concerns are still inflation and the consumer, and tariffs are still poised to increase inflation, reduce profits, and slow consumer demand. Given the fiscal policy backdrop and relatively expensive stock prices at the beginning of this year, we expect stocks to remain stuck in neutral until we have more clarity on earnings growth. In the meantime, Bond yields continue to push higher, offering the most compelling returns in nearly 20 years. The dollar continues to weaken. Stocks of companies outside the U.S. look increasingly attractive. We are actively increasing investment in non-U.S. stocks. The U.S. economy is driven by a very resilient U.S. consumer, and it will move forward, but the headwinds this year are significant. It likely will take some time to gain clarity in corporate earnings growth and the appropriate valuation of U.S. equities. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports directly in your inbox. Thank you very much for watching.